Have you been considering a cash-out refinance? Do you know how it can help you? Are you overwhelmed by all the details? Well, today, we're going to unravel the mysteries and help you make the best decision possible. Simply put, this financial strategy allows homeowners to borrow more than what they owe on their mortgage and receive the difference in cash. Imagine your home as a piggy bank that you've been filling up over the years. A cash-out refinance is like breaking open that piggy bank when you need it the most. But here's the catch. Not everyone can just break open their piggy bank. To qualify for this, homeowners need to have more than 20% home equity. Think of this as the part of your home that you truly own, free and clear of any mortgage. So, if you've been faithfully paying off your mortgage and the value of your home has increased over time, you might have built up enough equity to consider a cash-out refinance. Now that you have a basic understanding of what a cash-out refinance is, let's dive into the process. So, how does a cash-out refinance work? Well, let's dive right into it. The process begins with qualifying for a higher loan amount than what you currently owe on your mortgage. This step is crucial because it's this extra amount that will eventually be transformed into cash in your pocket. Now, qualifying for this higher loan amount isn't a walk in the park. Lenders will take a close look at your income, credit history, and existing debts to determine if you can manage the increased loan payment. Next, it's time for a home appraisal. An appraisal is a professional evaluation of your home's market value. This is a critical part of the cash-out refinance process, as the appraisal will determine the maximum amount you can borrow. So if you've been considering those home improvements, now might be a good time to get them done. Once the appraisal is complete, the lender will finalize the loan amount. Here's where the concept of the loan-to-value, or LTV ratio, comes into play. The LTV ratio is a comparison of your loan amount to the appraised value of your home. Most lenders set a limit of 80% on the LTV ratio. This means that the sum of your new loan and your existing mortgage can't exceed 80% of your home's value. Now, let's say your home is worth $200,000 and you owe $100,000 on your mortgage. An 80% LTV limit would allow you to borrow up to $60,000 more. Once the loan is finalized, you'll receive this extra amount in cash. But before you start dreaming about what you'll do with that cash, it's important to note one thing. The cash-out refinance process and requirements can vary depending on the type of loan you have, be it conventional, FHA, or VA. Remember, the rules can vary based on the type of loan. Now, let's discuss these variations. Did you know that guidelines for cash-out refinances can vary by loan type? Yes, indeed they do. Let's explore the different loan types and their unique requirements for a cash-out refinance. Firstly, we have the conventional loans. If you're considering a conventional loan for a cash-out refinance, you'll generally need more than 20% home equity. Lenders will also use the loan-to-value, LTV ratio, to determine how much of the home's value you can cash out. Most lenders set a limit of 80%, which means you can borrow up to this percentage of your home's value, minus what you owe on your current mortgage. Next up are the FHA loans, short for Federal Housing Administration loans. These loans are a bit more lenient. They allow you to cash out up to 85% of your home's value, assuming you meet the other requirements. FHA loans are especially popular among homeowners with lower credit scores and higher debt-to-income ratios because of their more flexible lending standards. Lastly, we have the Veterans Administration, or VA loans. These loans are a boon for our veterans and active duty service members. With VA loans, you can cash out up to a whopping 100% of your home's value. While these numbers might sound enticing, remember that each of these loan types comes with its own unique set of requirements. Factors such as your credit score, your debt-to-income ratio, and the current status of your mortgage can all influence your eligibility for a cash-out refinance. Understanding these differences is essential. It can help you choose the best option for your individual situation, whether that's to cover a significant expense, consolidate debt, or make a large purchase. It's all about knowing your options, assessing your financial situation, and making an informed decision. Choosing the right loan type is crucial to make the most out of a cash-out refinance. But what factors influence the rates of a cash-out refinance? Stay tuned to find out. The rates of a cash-out refinance can be higher than regular refinance rates. But did you know you can potentially improve these rates? Indeed, there are several factors at play here. Firstly, maintaining a high credit score is crucial. Lenders are more likely to offer you a better rate if your credit score is high, as it signals your reliability as a borrower. It's a good idea to keep tabs on your credit score and take steps to improve it if it's less than stellar. Secondly, the loan-to-value ratio, or LTV, is another key consideration. This ratio is determined by dividing your loan amount by the appraised value of your home. The lower your LTV ratio, the less risk you pose to lenders, which can lead to a lower interest rate. Lastly, making home improvements can also influence your refinance rates. If these improvements increase the value of your home, your LTV ratio can decrease, leading to potentially better rates. It's important to remember that every situation is unique, and these factors may not have the same impact on everyone's refinance rates. Improving these factors can significantly impact your cash-out refinance rates. But what about the closing costs? Closing costs are an important aspect of cash-out refinance to consider. They're those extra charges that crop up when you finalize a refinance deal, and they typically range from 2 to 6% of the loan amount. Now, that might sound like a lot, but remember, we're dealing with a percentage of your loan, not your home's total value. These costs can include a variety of expenses, such as fees for the home appraisal, loan origination, attorney services, and more. The good news is that you have some flexibility with these costs. You can choose to pay them out of pocket, which means you'll need to have some cash set aside when you close the deal. Alternatively, you can opt to deduct them from the cashback funds you receive from the refinance. Now, this might seem like an attractive option, especially if you're tight on cash, but remember, if you choose this route, you'll be borrowing more and in turn paying more in interest over the life of the loan. So, it's essential to weigh your options carefully and decide what's best for your financial situation. Understanding these costs can help you plan your finances better during a cash-out refinance.